There's something your bank doesn't want you to know. It's perfectly legal. It's been happening for decades. But when you understand it, you'll realize why the biggest players are quietly moving their money. This isn't conspiracy. It's a liquidity reality that most people ignore until it's too late. Stay with me for the next few minutes, because I'm going to walk you through exactly what is happening inside the US banking system right now. By the end of this video, you'll understand why depositors pulled over $470 billion from banks in just the first quarter of the 2023 crisis. You'll see the 3 specific ratios that determine whether your bank is safe or at risk. And most importantly, you'll know the exact questions to ask and the steps to consider for protecting your own money. This isn't about fear. This is about being informed when it matters most. Let me start with something simple. When you deposit $1,000 into your bank account, where does that money go? Most people assume it sits in a vault with their name on it. But here's the reality that changes everything. Your bank is only required to keep a fraction of your deposit on hand. The rest, they lend it out, invest it, or use it to make more money. This is called fractional reserve banking. Right now, US banks operate on reserve requirements as low as 0% for certain accounts. Yes, 0. Your money becomes their money the moment you deposit it. Now, here's where it gets critical. Banks make money by borrowing short and lending long. They take your deposit, which you can withdraw anytime, and they lock it into long-term loans and investments, mortgages, business loans, treasury bonds that mature in 10 or 20 years. This works perfectly fine when interest rates are stable. But something dramatic happened starting in 2022. The Federal Reserve raised interest rates faster than any time in 4 decades. They went from near 0 to over 5% in less than 18 months. This created a problem that most people still don't understand. When interest rates rise quickly, the value of existing bonds and loans falls. It's simple math. If you're holding a bond that pays 2% interest and new bonds are paying 5%, your bond is worth less, much less. Banks across America are sitting on these older, lower-yielding assets. According to the latest data entering 2026, U.S. banks are still sitting on nearly $400 billion in unrealized losses. While this is down from the peaks of 2023, it's a massive drag on the system. And remember the Bank Term Funding Program, the emergency safety net the Fed launched back in 2023. That program ended in March 2024. The training wheels have been off for almost 2 years now. If a bank gets into trouble today, they don't have that easy liquidity window anymore. They have to sell assets and they have to take the loss. This is exactly what happened to Silicon Valley Bank in March 2023. It was the 16th largest bank in America. Customers started withdrawing deposits. To pay those withdrawals, SVB had to sell some of their long-term bonds. But because interest rates had risen so dramatically, those bonds had lost significant value. Selling them turned unrealized losses into realized losses. This created a bank run. Within 48 hours, customers attempted to withdraw $42 billion. The bank collapsed. It was the second largest bank failure in U.S. history. Then Signature Bank failed. Then First Republic, 3 major banks gone in a matter of weeks. Now, here's what you need to pay attention to. The FDIC insures deposits up to $250,000 per depositor per bank. That insurance is backed by the Deposit Insurance Fund, which has about $125 billion in it. Sounds like a lot, right? Until you realize that there are roughly $10.5 trillion in total bank deposits in the United States. The insurance fund covers barely 1% of all deposits. The system works on the assumption that not all banks will fail at once. But what happens when confidence starts to crack across multiple institutions? Simultaneously, we got a preview of that answer back in 2023. Let me show you something that should concern every person watching this. After those 3 banks failed, federal regulators conducted stress tests on the entire banking system. They found that 186 banks have significant unrealized losses that could threaten their stability if depositors lose confidence and start withdrawing money. These aren't tiny community banks. We're talking about institutions holding hundreds of billions in assets. The problem is concentrated in regional banks that loaded up on long-term bonds when interest rates were low, but it spreads across the entire system. And here's the part that kept me up at night when I first understood it. This is not about whether these banks made bad decisions. They followed standard practices. The rules of the game changed faster than institutions could adapt. So what does this mean for your money right now? First, understand that not all banks face the same level of risk. The largest banks, the too big to fail institutions, generally have more diversified portfolios and better liquidity positions. Smaller regional banks with concentrated commercial real estate exposure or heavy investments in long-term securities face higher risks. Second, the speed of modern banking changes everything. In 2008, bank runs took weeks. Silicon Valley Bank experienced the fastest bank run in history because customers could withdraw money with a phone tap. Digital banking means digital bank runs. Fear spreads at the speed of social media. Now, here's something else flying under the radar. Commercial real estate is facing its own crisis right now. Office buildings are sitting empty because of remote work. Property values have dropped significantly. Banks hold enormous amounts of commercial real estate loans on their books. When these loans come due for refinancing, many property owners can't qualify at today's higher interest rates. Default rates are climbing. This creates another layer of potential losses for banks, stacked on top of the unrealized losses from their securities portfolios. It's a double pressure point that hasn't fully materialized yet, but the trajectory is clear. Let me give you the 3 numbers you need to know about your bank. First, the Texas ratio. This measures a bank's credit losses against its tangible equity capital. Any bank with a Texas ratio above 100% is considered an elevated risk. Second, the Tier 1 capital ratio. This shows how much high-quality capital a bank has relative to its risk-weighted assets. You want this above 8%, ideally above 10%. Third, look at the ratio of uninsured deposits. These are deposits above the FDIC limit. If a large percentage of a bank's deposits are uninsured, those depositors are more likely to pull money at the first sign of trouble, creating exactly the kind of run that kills banks. These numbers are public. You can find them. Now, here's what makes this moment different from 2008. Back then, the problem was bad loans, primarily subprime mortgages. Banks had made loans to people who couldn't pay them back. This time, the assets themselves aren't necessarily bad. A treasury bond is backed by the US government. But when interest rates rise dramatically, even safe assets lose value. The problem isn't quality, it's duration and liquidity. There is one more factor squeezing the system: the Basel III endgame. These new capital rules started phasing in last July. To comply, banks have to hold more capital against their risks. How do they do that? By lending less. This is why you might have noticed it's harder to get a small business loan or a mortgage this year than it was 3 years ago. The banks are hoarding cash to satisfy regulators, leaving less liquidity for the rest of the economy. What's fascinating and frankly concerning is how quiet this situation remains in mainstream coverage. After the initial panic in March and April of 2023, the news cycle eventually moved on. But the underlying issues haven't been resolved. Those unrealized losses are still sitting on bank balance sheets. Commercial real estate continues deteriorating. Regional banks continue struggling with deposit outflows. The band-aid that regulators applied primarily through the Bank Term Funding Program was a temporary measure. It allowed banks to borrow against their underwater securities at face value rather than market value, preventing forced sales. But that program has limits and eventually ends. So what are sophisticated investors actually doing right now? They're diversifying where they keep cash. Instead of holding everything at one institution, they're spreading deposits across multiple banks to stay within FDIC limits at each one. They're looking at the financial health of their banks using those ratios I mentioned. Some are moving money to the largest, most systemically important banks that have implicit government backing. Others are exploring alternatives like treasury bills purchased directly, money market funds, or even physical assets. The key word is diversification, not putting all eggs in one basket, especially when that basket's structural integrity is questionable. Here's what you need to understand about FDIC insurance. Yes, it protects you up to $250,000, but even with insurance, there's a process. When a bank fails, the FDI takes it over. If they can quickly sell it to another bank, you might get access to your funds within days. If they can't find a buyer, they issue you a check, which can take longer. During that time, you can't access your money. For individuals living paycheck to paycheck, or small businesses managing cash flow, even a week without access to funds can be devastating. Insurance is protection, but it's not instant and it's not painless. Let me address something important. I'm not telling you to panic. I'm not saying every bank is going to fail tomorrow. What I am saying is that the US banking system is under structural stress that hasn't been resolved. The mathematics of fractional reserve banking combined with rapid interest rate changes creates vulnerabilities. Being aware of these vulnerabilities allows you to make informed decisions. Knowledge is the difference between being a victim of circumstance and being someone who saw it coming and took reasonable precautions. Think about what happened to depositors at Silicon Valley Bank who had more than $250,000 in their accounts. Initially, they faced losing everything above that insured amount. The government ultimately backstopped all deposits at SVB to prevent wider panic, but that decision was made in real time during a crisis. There was no guarantee it would happen. Relying on emergency government intervention is not a financial strategy. Understanding the risks and positioning yourself accordingly is. The commercial real estate situation I mentioned earlier is the real story of 2026. We are watching roughly 1.5 trillion in commercial loans mature right now. And here is the scary number. Analysts project that over 50% of the commercial mortgage-backed securities maturing this year will default at maturity. Why? Because these buildings are worth less than the loans on them. When a developer can't refinance, they hand the keys back to the bank. And suddenly, your regional bank isn't just a lender. They're a landlord of an empty office building that nobody wants. The U.S. banking system operates on confidence and liquidity. When confidence erodes, depositors withdraw money. When depositors withdraw money, banks must sell assets. When they sell assets in a high-interest rate environment, they realize losses. When they realize losses, confidence erodes further. It's a cycle, and we saw it play out in real time during the Silicon Valley Bank collapse. The question isn't whether the system has problems. The data clearly shows it does. The question is whether those problems will escalate into another crisis or whether we will muddle through as interest rates potentially stabilize. What should you do with this information? First, know where your money is and how much you have at each institution. Second, check if you're within FDIC limits or if you need to spread deposits. Third, research your bank's financial health using public data. Fourth, consider whether you're comfortable with your current setup or if you want to make changes. Fifth, stay informed as the situation develops. This isn't static. New data comes out quarterly. The situation evolves. I want to be crystal clear about something. I'm not a financial advisor, and nothing in this video constitutes financial advice. These are observations about the banking system based on publicly available data and historical patterns. Your personal financial situation is unique. What makes sense for one person might not make sense for another. The goal here isn't to tell you exactly what to do. The goal is to give you the information and context to make your own informed decisions. Now, I know what some of you are thinking. This is overwhelming. Where do I even start? That's exactly why I built something for you. It's called the Fortress Runway Calculator. Here's what it does. You plug in 3 numbers: your monthly survival burn rate, your debt payments, and how many dependent you have. The calculator instantly shows you exactly how many months of runway you have with your current setup. Not a guess, an actual number. Most people discover they have way less cushion than they thought. But here's the powerful part. It also gives you your ideal Layer 1, Layer 2, and Layer 3 cash targets based on your specific situation, plus the exact refill rules to maintain them. It's just a tool that shows you exactly where you stand and what your target should be. And it's completely free. You can access it right now through the link in the description below. Go run your numbers right now while this information is fresh. Knowledge without action is just entertainment. Let's turn this into actual protection for your money. Back to the topic. The reality is that most people will never face a problem with their bank. Most banks will navigate this period successfully, but most isn't the same as all. And when it's your money on the line, you deserve to understand the landscape. The difference between 2008 and now is that in 2008, regular people didn't see it coming. The warning signs were there, but they weren't widely understood until after the crash. This time, the warning signs are visible. The data is public. The question is whether people will pay attention or assume everything is fine because that's what they're being told. Financial systems are built on trust. That trust is usually justified, but it's not guaranteed. Understanding the mechanics behind that trust, knowing when it's well placed and when it might be tested, that's the difference between financial literacy and financial vulnerability. You now understand more about how the banking system actually works than most people ever will. You know about fractional reserves, unrealized losses, the FDIC's limitations, and the specific pressures facing banks today. You're equipped to ask better questions and make more informed decisions. The truth is, your bank doesn't want you thinking about any of this. They want you to deposit your money, trust the system, and not ask uncomfortable questions. And most of the time, that's fine, but we're not in most of the time right now. We're in a period where the rules change fast, where hidden losses sit on balance sheets, where confidence is fragile. Being aware doesn't mean being afraid. It means being prepared. And preparation is always better than panic.